Welcome to the first of many educational seminars on the OTC derivatives regulatory regime in Ontario. Today we are going to discuss OTC derivatives trade reporting in Ontario as we answer the question, what are your obligations? The presentation will cover an introduction to trade reporting rules, the TR and scope rules publication history, what is required to be reported under the rules, which derivative contracts must be reported, who must report, data dissemination by trade repositories, amendments to the TR rule, effective dates, what is reported, what is a UTI, UPI, and LEI, and future regulations. So why do we have a trade reporting rule? This goes back to the G20 commitments from September 2009 at the Pittsburgh Summit. The main derivative commitments made by the leaders at that time were that all standardized OTC derivative contracts should be traded on electronic trading platforms, cleared through central counterparties, and that OTC derivative contracts should be reported to trade repositories, and that is the subject of today's presentation, and that non-centrally cleared contracts should be subject to higher capital requirements. The policy aims of the trade reporting rule are to improve transparency and regulatory oversight in the derivatives market, to identify and address systemic risk and the risk of market abuse, and to support policymaking by providing regulators with information on the nature and characteristics of the Canadian derivatives market, including the impact on end users. This information will enable the regulators to produce regulations and rules that are fact-based. The two rules we're talking about today are OSC Rule 91506, the Derivatives Product Determination Rule, otherwise known as the Scope Rule, and OSC Rule 91507, Trade Repositories and Derivatives Data Reporting, the TR Rule. The consultation paper for these came out in 2011. The model rules followed late 2012. The proposed Ontario rules mid-2013, and the final Ontario rules were published on November 14, 2013, and became effective on December 31, 2013. The amendments to these rules were published on April 17, 2014, and are expected to become effective on July 2, 2014. Now we will move on to the content of these new rules and what you need to know when you enter into a derivative.
This section will deal with what is required to be reported and who is required to report. Reportable transactions trigger the reporting obligations under the trade reporting rule. A reportable transaction is a transaction involving a local counterparty. Reportable transactions must be reported to a designated trade repository that has been designated in Ontario. So what is a transaction? A transaction includes assigning, novating, selling, or otherwise acquiring or disposing of a derivative. A transaction does not include a material amendment, as a material amendment that does not result in a new transaction would be reported as a life cycle event. So what is a transaction in a derivative? What is a derivative? A derivative is determined under the Ontario Securities Act and the Scope Rule. The definition of derivative under the Ontario Securities Act is very broad. The Scope Rule articulates the instruments within this broad definition that are and are not required to be reported to a designated trade repository. The Scope Rule prescribes the following instruments that may meet the broad definition of derivative, not to be derivatives, for the purposes of the trade reporting rule. Gaming contracts, insurance contracts, spot FX contracts, physical commodity contracts, deposits at banks, credit unions, and trust companies, and exchange-traded derivatives. It is important to note that the carve-out for exchange-traded derivatives does not extend to transactions executed on swap execution facilities, which are required to be reported under the rule. This provision highlights a sequencing challenge we face in our rule drafting. We do not yet have trading rules in place defining a derivatives trading facility, but the definition will be similar to that of the U.S. concept of swap execution facility and the European Union concept of a multilateral trading facility. As an example, a transaction executed on the Montreal Exchange will not be required to be reported, whereas a transaction executed on a CFTC-registered swap execution facility would be required to be reported. The scope rule also prescribes treatment for hybrid instruments, or instruments that meet the broad definition of both derivative and security. Generally, most instruments currently treated as securities will remain under the securities regime and not be required to be reported. Some examples of hybrid instruments that would not be required to be reported are structured notes, asset-backed securities, warrants, and securities of investment funds. A reportable transaction is one that involves a local counterparty. So what is a local counterparty? A local counterparty includes a person or company organized under Ontario law, a person or company that has its head office or principal place of business in Ontario, a guarantee affiliate of one of the first 2 points. A word on guarantee. A guarantee must be for all or substantially all of an affiliate's liabilities. Therefore, the fact that one transaction is fully guaranteed would not necessarily make an affiliate a local counterparty. Conversely, if an affiliate is guaranteed for all but one transaction, it could still be a local counterparty. A guarantee does not relate only to derivatives transaction, but to the entity in general. The final prong of the local counterparty definition is an Ontario registered derivatives dealer or party registered in an alternate category as a consequence of trading in derivatives. This is another example of the sequencing problem we referred to earlier. We use the term or registered in an alternate category because we do not yet have a registration regime in place. The registration regime in Ontario will include a category of large derivative participants. And this is what these terms are intended to represent. A final word on local counterparty. It is possible to be a local counterparty in multiple Canadian jurisdictions. However, as reporting will be harmonized, one report can satisfy the requirements of multiple jurisdictions. Okay, now let's move on to who must report. Under the trade reporting rule, the reporting counterparty is under the duty to report a reportable transaction to a designated trade repository. Who the reporting counterparty is depends on the transaction counterparties. For transactions involving a recognized or exempt clearing agency, it would be the recognized exempt clearing agency that is required to act as reporting counterparty. For a transaction involving a derivatives dealer, the derivatives dealer is required to report. And end-user local counterparties are required to report for uncleared transactions not involving derivatives dealers. The term derivatives dealer is used in 2 contexts in the trade reporting rule. The first context is in defining a local counterparty. For this purpose, a derivatives dealer must be registered as a derivatives dealer in Ontario. As mentioned earlier, the registration regime is not yet in place in Ontario, and therefore, until that time, there will be no registered derivatives dealers. However, for the purposes of the reporting counterparty, of determining the reporting counterparty, the derivatives dealer definition is not contingent on registration. So a derivatives dealer, for the purposes of a reporting counterparty, is a party that is engaging in the business of trading in derivatives in Ontario as principal or agent. In order to determine whether your activities would be considered to be in the business of trading, it would be useful to review the proposed business triggers in CSA Consultation Paper 91-407, Derivatives Registration. This consultation paper is available on the OSC website. And now a word on delegation. Delegation is an important concept under the rule. Reporting counterparties may delegate all reporting obligations. Our expectation is that delegation will be used to avoid double reporting. For example, although a transaction between two local counterparties is technically required to be reported by both, we would expect that the reporting obligation would be delegated to one party who would report. We are striking a balance between allowing flexible one-sided reporting while ensuring that reporting does in fact occur. Now, all derivatives data for a single reportable transaction must be reported to the same designated trade repository. This is to ensure that all data regarding a particular transaction is held in the same place. However, this does not prevent a transaction from being reported to another non-designated trade repository in a foreign jurisdiction. For transactions involving a clearing agency, the clearing agency must act as reporting counterparty. It also must report derivatives data to a designated trade repository selected by the local counterparty. Errors and omissions. Upon discovery of an error or omission in reported derivatives data, the reporting counterparty must notify the designated trade repository as soon as technologically practicable and no later than the end of the next business day. A local counterparty other than the reporting counterparty has the obligation to notify the reporting counterparty in the event the local counterparty discovers an error and omission. It would then be the reporting counterparty's obligation to notify the designated trade repository.
When to report. This section addresses the timing of reporting obligations under the rule. The goal of the rule is for real-time reporting of derivatives data. Real-time reporting means that data must be reported as soon as technologically practicable. This is consistent with the approach of other jurisdictions, such as the CFTC in the United States. What does technologically practicable mean? It's a contextual determination which considers several factors, such as the state of technology, the norms that have developed with reporting in other jurisdictions as reporting becomes more prevalent, and importantly, the relative competencies of market participants. For example, we would expect that dealers have more experience in reporting than end users, and as such, will be reporting in a more timely fashion. Although real-time reporting is an interpretive concept, the rule acknowledges this by setting out some firm deadlines that set outside time limits for reporting, which I will turn to in the next slide. The outside timing deadlines for derivatives data depend on two factors. First, on the vertical axis, the type of data being reported. Second, listed on the horizontal axis, is the type of reporting counterparty. For creation data, all creation data must be reported by all reporting counterparties as soon as technologically practicable, and no later than the end of the business day after which the transaction has been executed. This is subject to one important exception for end users, which I will turn to in the next slide. Lifecycle event data must be reported by all reporting counterparties by the end of the day on which the lifecycle event occurred, but no later than the end of the business day after the day of the event. The reporting of valuation data depends on the type of reporting counterparty. Reporting counterparties who are end users must report valuation data on a quarterly basis and within 30 days of the end of the calendar quarter, whereas all other reporting counterparties must report daily. Finally, errors and omissions must be reported by all counterparties as soon as the error or omission has been discovered, either directly to the TR or to the reporting counterparty. Two further interpretive concepts apply when dealing with timing of reporting obligations. The first is business day. Business day is interpreted as the business day in the geographic location in which the reporting counterparty is located. The second is the interaction between the delegation function, which was discussed in slide 14, and its impact on timing of obligations. Where one party delegates its reporting obligation to another, the more onerous timing requirements will apply. For example, if an end user enters into a transaction with a dealer and the dealer delegates the reporting obligation to an end user, the dealer timing obligations continue to apply, and the user must, for example, report valuation data on a daily basis. The next section addresses the issue of data dissemination under the rule. Under the rule, designated trade repositories are required to grant counterparties access to data which has been reported in relation to a reportable transaction involving those counterparties. So, for example, where a transaction has been entered into between an end user and a dealer and is reported by the dealer, the trade repository must allow the end user to access the derivatives data that has been reported. Further, we expect that where a counterparty to a reported transaction has granted access to a third-party service provider, that the trade repository will grant the third-party service provider with access on the terms agreed to by the parties. This slide addresses the public dissemination of aggregated derivatives data. As part of the policy aim of increased market transparency, designated trade repositories are required to publicly disseminate certain aggregated data. The rule requires the trade repositories to make available on their websites information regarding the notional amounts, volumes, and pricing of reported transactions on an aggregated basis in order to provide more information to market participants. This slide addresses the public dissemination of transaction-level data. A further step in increasing market transparency is the dissemination of transaction-level data. The rule prescribes that in releasing such data, a designated trade repository must ensure that the information is anonymized. That is, that the counterparties to the transaction are not identified. This requirement strikes a balance between increasing market transparency, which promotes efficient markets, and ensuring that counterparties have adequate time to enter into any offsetting transaction that may be necessary to hedge their position. Accordingly, we have implemented delays which we believe will assist counterparties in entering into offsetting transactions. A designated trade repository must make transaction-level reports available 1 day after receiving the data if the transaction involves a derivatives dealer, and 2 days for transactions involving reporting counterparties that are not derivatives dealers. On April 17th, the Ontario Securities Commission published amendments to the Ontario Derivatives Trade Reporting Rule. Subject to ministerial approval, the amendments will come into force on July 2nd, 2014. There are 3 main modifications to the TR rule that we would like to highlight in this presentation. First, amendments to delay compliance dates for reporting obligations under the rule, including for pre-existing derivatives. Second, the repeal of the local counterparty fallback provision. And finally, an amendment to delay the public dissemination of transaction-level data by designated trade repositories. In respect of the extensions of time for compliance with the general reporting obligations under the rule, where a reporting counterparty to a transaction is a derivatives dealer or a recognized or exempt clearing agency, the duty to report derivatives data in respect of that transaction has been delayed from July 2nd, 2014 to October 31st, 2014. Further, derivatives dealers and clearing agencies are required to report pre-existing reportable transactions no later than April 30th, 2015. For all other reporting counterparties, the duty to report derivatives data in respect of a reportable transaction has been delayed from September 30th, 2014 to June 30th, 2015. Further, the deadline for those counterparties in respect of pre-existing transactions has been delayed to December 31st, 2015. As a result of the amendment to delay the general duty to report derivatives data, corresponding changes were made to the provisions governing pre-existing transactions. Changes to the criteria for identifying and reporting pre-existing transactions now depend on whether or not the reporting counterparty is a derivatives dealer or a clearing agency. Where the reporting counterparty is a derivatives dealer or recognized or exempt clearing agency, a derivative transaction is prescribed to be a pre-existing derivative if the derivative was entered prior to October 31st, 2014, and the derivative does not terminate or expire prior to April 30th, 2015. If both conditions apply, the transaction is deemed to be a pre-existing transaction and must be reported no later than April 30th, 2015. However, where the transaction does expire or terminate prior to April 30th, 2015, it is not required to be reported. For all other reporting counterparties, a derivative transaction is prescribed to be a pre-existing derivative for the purposes of the rule if the derivative was entered prior to June 30th, 2015, and the derivative does not expire or terminate prior to December 31, 2015. If both conditions apply, the transaction is deemed to be a pre-existing derivative and must be reported no later than December 31st, 2015. Where the transaction does expire or terminate prior to December 31st, 2015, it is not required to be reported. Note that for all reportable pre-existing derivatives, only those fields identified in Appendix A as necessary for pre-existing transactions are required to be reported. The April 17th amendments to the Trade Reporting Rule also include the repeal of subsection 25.2 and subsection 31.4. Together, these provisions were known as the local counterparty fallback. Previously, under the provisions of the rule, a local end user was subject to a residual obligation to monitor whether or not their foreign dealer counterparty satisfied the reporting obligations under the Ontario rule. This is no longer the case. Any transaction between a dealer and an end user must be reported by the dealer, who bears the sole obligation to ensure the reporting has been completed in compliance with the rule. This change was made in recognition of the significant resource and technological costs that local end users would bear in order to implement monitoring systems. The Commission believes that the costs of such a residual monitoring obligation outweighs the benefits and has therefore repealed those provisions. This slide summarizes the important dates in respect to the rule and also reflects changes made by the amendments. The Trade Reporting Rule came into force on December 31st, 2013. The general reporting obligation for dealers and clearing agencies now begins on October 31st, 2014. Public dissemination of transaction-level reports by a designated trade repository now begin on April 30th, 2015. And the reporting obligation for all other counterparties begins on June 30th, 2015.
So now we'll look at what is reported and derivatives data and international standards. First, we'll look at creation data, and creation data consists of initial transaction data as required by Appendix A, and as discussed in previous slides, there's different timing for all of these items. Next, we'll look at lifecycle event data, which is the continuation data through the life of a derivative transaction, or more clearly, it's the changes to previously reported data. Next, we'll look at valuation data, which is the periodic mark-to-market value of a derivative or the mark-to-model value. And last, we'll look at international standards, which covers LEIs, UTIs, and UPIs, or for UTIs, it's the transactions, and UPI is the product types. Okay, and continuing on to slide 28 of what is reported, we'll look at the parties to a derivative. As you can see in the table, in the first row, we have the clearing agency. In the second row, the clearing member. The third row, we have clearing exemption. And in the fourth row, we have broker. For fields in orange, those are fields that are different than CFTC requirements. And in this table, we also have the third column and the fourth column, which shows if it's required for public dissemination in the third column, and in the last column it shows if this field will be reported for pre-existing transactions. As you can see, clearing agency and clearing member is not required to be publicly disseminated. Clearing exemption will be publicly disseminated, and this is just a yes or a no. The broker will not be publicly disseminated. As you can see, for the identifier for all of these parties to a derivative, you require an LEI, and this will be discussed in more detail later on. And finally, if we look at pre-existing transactions, you'll see all of these field requirements are not publicly reported, are required for pre-existing transactions, except for clearing agencies. Okay, and now we'll continue on parties to the derivative. As you can see on slide 29, we'll go over the counterparties and the identifiers that are required for each of them. As you can see, they also require an LEI. And as you can see in the third column, this information will not be publicly disseminated, but we do require this information for pre-existing transactions. We also have the last row, which is counterparty side. This just allows us to know who the buyer or the seller is to each transaction. This field is not publicly disseminated, and we also require it for pre-existing transactions. Next, we move to slide 30, and we continue on with party to a derivative. Here we have the identifier of an agent reporting the transaction. We have the field if it's a dealer or a non-dealer in the middle row there. And then we have, is the non-reporting counterparty a local counterparty or not a local counterparty as described in our rules. For the identifier of the agent, you also need an LEI. And then the next two is just yes or no if it's a derivatives dealer or your local counterparty. None of this information is required to be publicly disseminated, or is it required to be reported for pre-existing transactions. Okay, now we'll move to what is reported contract types. For here in the first row, you'll see you're required to report a unique product identifier. Next row, you see we request for the underlying asset identifier, and if there's more than one asset, we require you to also report that. And if there's any additional assets, we also require that to be reported. Last, or second last, you see an asset class, and this is credit, commodity, foreign exchange, or equity. And one thing we'll mention is if any of these are captured within the unique product identifier, they do not need to be reported. Only the unique product identifier needs to be reported. In the last row there, we require a field if the trade was an inter-affiliate one or not. Now we look at the column for public dissemination. As you can see, the unique product identifier and the underlying assets and the asset class will be publicly disseminated. But for inter-affiliate transactions, this will not be publicly disseminated. For pre-existing transactions, you do not require a UPI, but you do require to specify the underlying asset. For asset class and inter-affiliate, this is not required for the pre-existing transactions. Next, we'll look at, for what is reported, we'll look at transaction details on slide 32. In the first row, we have a transaction identifier, or a UTI, or in the US, this is referred to as a USI. This information will not be publicly disseminated, as you can see in the third column, but we do require it for pre-existing transactions. Next, you'll see we also require the master agreement type and a master agreement version, and as mentioned before, fields in orange are not required by the CFTC, but they are required by European regulations. And this is only to highlight some of the differences if you're already reporting under CFTC requirements. Looking at transaction details for transaction identifier or the master agreement version or type, this information is not publicly disseminated, or is it required for a pre-existing transaction with the exception of a UTI or transaction identifier. Next, we'll move to next we'll continue on transaction details of what is reported. In the first row, you'll see we require the electronic venue identifier to be reported, and this is the LEI. As you'll see in the third column, for public dissemination, we only publicly disseminate a yes or a no that it was done on the venue. The LEI, or the name referred to the LEI, is kept confidential. And we also require this for pre-existing transactions. In the last row, we have a field called collateralization. And this field only looks at if it's fully collateralized, partially collateralized, one way, or if it's uncollateralized. This is publicly disseminated, and it is not required for pre-existing transactions. Next, for what is reported, we will look at valuation data on slide 34. As you can see in the first row, we require the value of a contract as reported by the reporting counterparty. And here we require the mark-to-market valuation or the mark-to-model valuation. This information, as you can see in the third column, is not publicly disseminated, nor is it required for pre-existing transactions. In the next row, you see that we also require the valuation date, and in the last row, we require the valuation type. And as mentioned, this is the mark-to-model or the mark-to-market valuation. None of these are required for public dissemination, and none of these valuation fields are required for pre-existing transactions. Now we'll just touch on other fields that are different from the CFTC requirements in case anyone is already reporting under their rules. So one field that is different applies to energy contracts, and this is, to energy commodity contracts, which is delivery point, and this is the delivery location. This information isn't required for public dissemination or for pre-existing transactions. Next, this also applies to energy contracts, is delivery connection points and a clearing timestamp. All of these fields, though, are required under European requirements, just not under CFTC requirements, and they'll be required under our requirements. So next, for what is reported on slide 36, we'll look at who creates a UPI and UTI. So the rules specify that a designated trade repository must assign a UTI to a transaction using either its own methodology or a unique transaction identifier previously assigned to the transaction. And this can include USI if that has been assigned to the transaction. Next, our rules specify that a reporting counterparty must identify each transaction with a unique product identifier or a UPI. So next we'll expand on unique product identifiers or UPIs. So currently the status of any UPI work is it has created a high-level UPI for all asset classes. Currently, as far as we know, there is no ongoing work. The UPI basically just describes with sufficient distinctness and specificity the derivative asset class, the subtype, the underlying product for the derivative. Now on slide 38, we'll discuss a little bit more about unique product identifiers, and as mentioned, ISDA has created a UPI taxonomy which can be found on the following web address. And as mentioned, this has been approved by the CFTC. We have some examples at the bottom of the slide that goes through the 5 main asset classes of credit, interest rate, commodity, foreign exchange, and equity. You can see in the last column there's a sample representation of each of them. Next, for what is reported, we'll touch on unique transaction identifiers. Currently, there is no Canadian methodology required, but all trades should have a UTI which is generated, communicated at the earliest possible point in the trade flow. If a trade requires a unique swap identifier, as we mentioned before, this can be used as the UTI. Also, UTIs required under other jurisdictions can be used. And to summarize, on slide 40, pre-existing transactions and public dissemination data fields are quite similar to the CFTC requirements. Creation data is primarily a combination of the CFTC's and ESBN's requirements. Last, TRs are a good resource for information on the reporting standards if you have any difficulty on any of the particular fields.
This next section will focus on legal entity identifiers, or LEIs, specifically requirements for end users under the rule. I'm going to focus on what is an LEI, who needs to have one, where you can get one, the process required to receive one, and your obligations once you do have one. An LEI is a 20-character code used to identify entities that enter into financial transactions. It was born out of the financial crisis when it was realized that it was very difficult to aggregate risk exposures of entities because there was no single one standard that was used globally. So the LEI project was endorsed by the G20 and sponsored by the FSB as a way to create a system which would result in a global standard for entity identification. The system is administered by an entity known as the Global LEI System and overseen by a group of global regulators, of which the Ontario Securities Commission is a member. Next, I'm going to discuss who needs to have an LEI under our rule. As was previously discussed, all reporting counterparties to a trade caught under the rule need to have and report their LEI. This would include mutual funds, trusts, partnerships, government agencies. Even though, strictly speaking, they are not legal entities, they would still need to, again, obtain and report their LEI. In addition to the reporting and non-reporting counterparties, there are other actors to a trade that also require an LEI, specifically the reporting agent, the clearing agency, the clearing member, the broker, and the electronic trading venue when they are associated with a trade. This next slide depicts the setup of the Global LEI system, and with respect to where you can obtain an LEI, the only area of importance are the boxes on the bottom, known as the local operating unit. This is the only part of the LEI system that issues and maintains LEIs. LEIs can be obtained from local operating units, or LOUs, that have been endorsed by the Regulatory Oversight Committee of the LEI system. This slide lists the LOUs that have been currently endorsed by the ROC. This list is growing all the time as the system expands, and the most up-to-date list of endorsed LOUs is available at the website leiroc.org, as listed on the bottom of the slide. Once you've determined where you will obtain your LEI, the process required to receive it is fairly straightforward. The LOU will require you to submit an application with reference information, which I will speak to on the next slide. Then the LOU will go through a validation process, which includes an authorization check to ensure that the individual is authorized to act on behalf of the entity, an exclusivity check to ensure that the entity has not previously received an LEI, and finally a data verification check to ensure that the reference data submitted with the application is accurate. The issuance time to receive an LEI takes between 1 to 3 weeks and costs between $200 to $300. Assisted registration is allowed if the LOU is notified. The data necessary to obtain an LEI include the official name of your entity, the address of the headquarters and the address of legal formation of the entity, and if applicable, the name of the business registry where your entity was formed and that business registry's identification for your entity. Once you receive your LEI, there are certain obligations that you need to adhere to, specifically the issue of exclusivity and each entity only receiving one LEI. Each entity may only ever receive one LEI and must use that one LEI wherever LEI reporting is required. Secondly, you must notify the LOU once any of your reference data information changes. The LOU itself is required to revalidate your reference data once per year. And finally, you are allowed to move or port your LEI or LEIs to another LOU if desired. As mentioned previously, the LEI initiative is the attempt to create a global standard for entity identification, and LEIs are required to be reported outside of Ontario. Specifically, the CFTC and EMIR both require the reporting of LEIs for OTC derivative transactions. Beyond OTC derivatives, LEIs are also being required to be reported in the United States by the U.S. National Association of Insurance Commissioners. The European Banking Authority has also proposed requiring reporting of LEIs, as is IROC for debt reporting transactions. At the moment, the global LEI system is not fully completed. In its place has been established an interim system of what are known as pre-LEIs. Currently, LOUs will be issuing pre-LEIs rather than LEIs. This has no implications for end users under the rule, as LEIs and pre-LEIs will merge together once the global LEI system is complete. The pre-LEI codes that are being issued will become LEI codes and will not change. So then, just to wrap up on a few key points from the slides on legal entity identifiers, under our rule, everyone needs to obtain an LEI. You can only receive an LEI from an LOU that's been endorsed by the Regulatory Oversight Committee. And finally, you use one LEI for all your LEI reporting.
We'd also like to point out a few other rules that are out for comment currently. The three of them are all clearing rules. The first one, OSC Rule 24-503, Clearing Agency Requirements, came out December 19th. On the same date, CSA Staff Notice 91-303, Model Provincial Rule on Mandatory Central Counterparty Clearing of Derivatives, came out. And finally, CSA Staff Notice 91-304, Model Provincial Rule on Derivatives, Customer Clearing and Protection of Customer Collateral and Positions. That came out on January 16th. All three of these rules are out for public comment until March 19th, 2014. We encourage you to review those papers and the rules and then provide us comments on them. We take the comments that we receive very seriously and make appropriate changes to the rules that will come out in the final versions. Thank you very much for listening to this presentation. You can find all matters relating to derivatives on the OSC website. If you go to the OSC website, you go up to the top right-hand corner, you'll see a derivatives button. Press on that and you'll find links to the rules, to frequently asked questions, to this presentation, which you'll be able to download, and many other items relating to derivatives regulation in Ontario. Thanks again.